Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate jargon to reveal the real story behind the numbers. Today we are dissecting LendingTree's latest quarterly report to see if this online loan marketplace is still the king of the jungle or if its branches are starting to wither. Imagine you are comparing loan offers online. That is what LendingTree does. They connect you with many lenders offering different loans and rates. Today we are looking at their financial health as of the 30th of September 2025 to see how they are doing. If you like getting straightforward insights from company reports, please hit that subscribe button and join our Discord community linked in the description below. Alright, let's dive into the numbers. At the end of September 2025, LendingTree had about $68.6 million in cash. That is down from about $106.6 million at the end of 2024. This decrease makes sense because they repaid a lot of debt this year. Speaking of debt, while they owe less in short-term debt, now about $3.9 million compared to a much larger $124.9 million at the end of 2024, their long-term debt actually went up. It increased from $344.1 million in 2024 to $388.3 million in 2025. This shows they might be borrowing more for future investments or operations. Now for the bottom line results, in the 3 months ending the 30th of September 2025, they reported a net income of $10.1 million. That is a significant comeback from a net loss of $57.9 million in the same period last year. For the 9 months ending the 30th of September 2025, they also posted a profit of $6.6 million compared to a loss of almost $50 million in 2024. This is a huge turnaround and very positive. Their total revenue saw a good jump. For the third quarter of 2025, revenue was $307.7 million, up 18% from $260.7 million in the third quarter of 2024. Looking at the longer 9-month period, revenue shot up 25% from $638.6 million in 2024 to $797.6 million in 2025. That growth is being driven by their insurance segment, home segment, and consumer segment. The insurance business is doing exceptionally well. In the third quarter, revenue was $203.5 million, a 20% increase. For the 9 months of 2025, it was $497.3 million, an impressive 32% jump. This growth is thanks to more customers wanting insurance and them earning more per customer. Interestingly, they note that while insurance carriers are making a lot of money and aggressively seeking new customers, this competitive market has also increased their marketing costs. The home segment, which covers mortgages and home equity loans, saw an 18% revenue increase in the third quarter to $38.1 million. For the 9 months, it was up 22%. A key driver here is home equity loans. They are seeing strong demand as mortgage rates remain high. However, their core mortgage business is still struggling with low demand for both refinances and new home purchases. The consumer segment, which includes credit cards, personal loans, and auto loans, also grew. Revenue was up 11% in the third quarter and 11% for the 9 months. Personal loans and small business loans are performing well. Small business loans specifically saw a 50% revenue surge in the third quarter thanks to investments in their sales team. Credit cards and other credit products, however, saw declines. Now let's look at how much they are spending to get these customers. Selling and marketing expense went up significantly. In the third quarter of 2025, it was $225 million, an increase of 16%. For the 9 months, it was $574.5 million, a whopping 28% increase. This is directly tied to their advertising spending, which is heavily focused online. They explain that they dynamically adjust these marketing budgets in response to anticipated revenue opportunities. They also highlight something called variable marketing expense and variable marketing margin. Essentially, they are saying that their online advertising costs, which are the main part of variable marketing expense, are working. They calculate that after taking out these variable marketing costs, they are left with a healthy variable marketing margin. In the third quarter, this margin was $93.2 million, up from $77.2 million last year. They present this as a key measure of their operational efficiency. Another important figure they highlight is adjusted EBITDA. This is basically their net income with certain expenses added back like depreciation, non-cash compensation, and litigation costs. It is a way for them to show their core operating profitability. For the third quarter of 2025, adjusted EBITDA was almost $40 million, a solid increase from $26.8 million during the same period in 2024. For the 9 months, it was $96.2 million, up from $71.9 million in 2024. This shows their underlying business is becoming more profitable. However, not everything is rosy. They had a significant loss on impairment of equity investments. In the 9 months of 2024, this was a massive $58.3 million. While it decreased to $1.2 million in 2025, that initial large loss from the previous year definitely impacted their financials back then. They also had a major litigation settlement. A class action lawsuit related to telemarketing practices resulted in a $18.9 million liability, which was approved in September 2025. This was a big hit to their expenses in the third quarter. Financially, they made big moves. In August 2025, they entered into a new $475 million credit facility. This was used to refinance their existing loans. They also repaid their remaining 0.50% convertible senior notes in July 2025. This suggests they are actively managing their debt to improve their financial structure. A somber note is the passing of their founder Doug Lebda in October 2025. This led to a leadership change, with Scott Perry stepping in as the new CEO. They anticipate about $3.3 to $5.9 million in extra costs in the fourth quarter due to accelerating stock awards for the former CEO. This change in leadership adds another layer to their future outlook. So what is the overall picture here? LendingTree is showing strong signs of recovery, with significant improvements in net income and revenue growth driven by their insurance and growing consumer businesses. They are effectively managing their marketing spend to drive that revenue. However, the mortgage market remains challenging, and they are facing increased competition and marketing costs in insurance. The leadership transition is also something to watch. Overall, they seem to be navigating economic headwinds well and appear to be heading in the right direction. Alright, that is our breakdown of LendingTree's latest report. What do you think about these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.